Hi, and welcome to this week's market update. Latest news. As peace talks between Russia and Ukraine appear to be stalled and not moving in a positive direction, President Trump spoke with President Putin this Monday on ending the war in Ukraine amidst rising pressure for peace. Negotiations stall, especially given Russia's demands for territory and guarantees regarding Ukraine's NATO and European ambitions, while on the Ukrainian side of things, concerns remain on ensuring a long-term security and lasting peace, as well as ensuring Ukraine's sovereignty moving forward. Over in the Middle East, President Trump visited Saudi Arabia, Qatar, and the United Arab Emirates in his first major international trip of his second term, as well as meeting Syria's leader, with the U.S. opening the possibility towards sanction relief on the Middle Eastern country. While the trip was mostly focused on each country's bilateral relation with the U.S., some important discussions were had on the situation in Yemen, with a potential ceasefire in the Gulf, which could ease trade tensions in the region, as well as potentially open the door for additional trade through the Red Sea. Weather. Looking at the latest weather forecast, temperatures across Europe are expected to see some slightly below average temperatures, particularly through the middle and end of this week. But overall, we still see temperatures along the seasonal average for this time of the year, with relatively mild conditions across the continent. In terms of precipitation, we do see some slightly more precipitation, particularly in the later half of this week and early next week in the Nordic region and Northern Europe. But overall, still seeing more limited precipitation there. In terms of average wind speeds there, we still see some lower average wind speeds across Europe, potentially hurting the outlook for wind power generation. Macroeconomics. We received the latest inflation figures for April for the euro area and for the US, which showed limited movement in terms of the inflation rate over the past month. Looking at year-over-year inflation rate, that remained relatively stable, but still slightly above the 2% target set by each respective central bank. In terms of core inflation, US core inflation remained stable in April, while the European core inflation saw an uptick of 0.3%. It will be important to see how the tariffs and the trade tensions between the US and Europe impact inflation figures in the coming months. Crude oil and LPG. In terms of the evolution of crude oil prices, we saw a slight uptick over the past week, with the frontier product increasing by around 1.5% for both Brent and WTI, while the front month saw some additional upside of around 2.3% for each product. Overall, the uptick in the market is very much being driven by some additional demand expectations. The IEA, for example, is now forecasting an additional 700,000 barrels per day of consumption globally. And this is largely on the back of the easing trade tensions, particularly between the US and China. On the other hand, limiting gains in the market is the commitment by OPEC Plus to increase production quotas in June, which could see the market become even more oversupplied, particularly in the shorter term. However, the overall situation remains uncertain given the uncertain economic outlook. Natural gas. Looking at natural gas pricing, there we see a slight uptick in the price level, particularly in 2025 and the first half of 2026. The front quarter, for example, is seeing an increase of around 1.5%, very much what we see for the frontier as well. The slight uptick in the market is certainly due to some tighter supply and demand expectations. On the supply side of things, a drop in LNG imports is tightening the overall supply outlook, while on the demand side of things, that similar optimism in crude oil markets is extending to natural gas markets, with some additional demand expectations as the economic outlook brightens slightly. Looking at European gas storage levels, we've seen those continue to increase over the past week, ending the week at just under 44.5 percentage points. We still see storage levels below the average since 2012 and still noticeably below last year's level, where we see a 22% deficit, which has remained stable over the last couple of weeks. In terms of the injection rate into storage, that has come down over the last week, as you can see here, and has now moved in line with both last year's levels and the average since 2012. It will certainly be interesting to see how this evolves during the summer months and if we'll continue to see high levels of injections into storage. In terms of the total supply and demand situation, as I mentioned earlier, some more concerns over the supply outlook with some tighter expectations, as we did see overall natural gas supply into Europe come down week over week. At the same time, we're also seeing total demand weaken over the last week, now in line with what we saw last year, with both supply and demand near the bottom of the range since 2019. In terms of the supply mix, we continue to see North Sea production and LNG send-outs the largest sources of natural gas into Europe. Although, as you can see here on the bottom left, we did see that drop in LNG send-outs going from near the top of the range in 2019 for this time of the year, moving closer to what we saw in 2022 and the average since 2019. The drop in LNG send-outs is reflective of the drop in overall LNG imports into Europe. The drop in LNG imports into Europe is as a result of the lower overall demand in Europe, but also due to the higher price that Asian consumers are currently willing to pay for natural gas, leading to some diversion of cargoes from Europe towards Asia. The overall investment fund position for TTF futures increasing the long positions over the past week, mainly on the back of that greater optimism regarding the overall economic outlook and overall gas demand in the future. But nonetheless, we still see a more cautious situation as net long positions remain significantly below the peaks that we saw at the end of 24 and early 2025. Coal. Coal prices over the past week came down, particularly in Europe, with a 2.4% decrease for the frontier product, very much reflective of the weaker overall demand for coal that we see in Europe, particularly from the power sector. EU and UK emission allowances. In terms of emission allowances, over the past week, we saw a very slight movement in the European side of things, with prices increasing just under 1% on the week. But nonetheless, over the last 4 weeks, we've seen prices increasing 8%. From the UK side of things, we've seen a sharp drop, with prices coming down around 6%. But nonetheless, we still see those at relatively higher levels compared to what we've seen over the last few months. The upward movement in the European market was very much driven by those renewed or greater optimism regarding the economic outlook, and as a result, the demand outlook for carbon allowances. While on the UK side of things, the drop could be explained due to the high level and some profit taken there for market participants, with price levels being very much continuing to be supported by the ongoing discussions of recoupling the European and UK markets. In terms of power sector emissions there, we've seen those come down over the last week, as we saw be the case last year, and overall emissions from the power sector remain at the bottom of the range since 2019, largely owing to the current weather conditions, but also the stronger renewable power generation from renewables, easing overall emissions from the power sector. Looking at these investment fund positions there, we saw a continuation of the slight uptick in net long positions on the European market, very much due to the greater optimism regarding the overall economic outlook and demand expectations for carbon allowances, while on the UK side, we continue to see net long positions at record highs. Electricity. Looking at the electricity price evolution, focusing on the German market, there we see pricing in the shorter term saw an uptick of around 3.8% from the front quarter, while the frontier saw pricing increasing by just under 2.6%. The upward movement was very much driven by the slight uptick in natural gas pricing, as well as the uptick in carbon allowance pricing that we've seen over the last few weeks. Additionally, some tighter generation and demand expectations are also expected in the electricity market, with the drier weather and this low snow cover potentially decreasing the outlook for hydropower generation during the summer months, while the poor wind power generation across Europe is also resulting in some additional demand for fossil fuel power generation. Looking at the evolution across European countries there, we see a similar evolution across most Western European countries, with France and Spain being an exception, owing to the different electricity mixes in each country there. While in the Nordic region, we see the drier weather outlook particularly drive up the price level over the last couple of weeks. In terms of total demand and residual load, we see both of those coming down over the last week, very much due to the improved weather conditions, with milder weather resulting in lower overall consumption. In terms of the supply mix there, we continue to note the drop in fossil fuel power generation, particularly gas and coal, as you can see here, with an uptick in the solar power output in particular, as we see that remaining at some of the highest levels we've seen for this time of the year. Nuclear power generation saw a slight uptick over the last week, mainly driven by the improvement in the French nuclear output. In terms of renewable and fossil fuel power generation there, we see a renewable power generation slightly below last year's levels, which is a little disappointing given the increases in installed capacities, while fossil fuel power generation remains near the same levels as we saw last year. In terms of renewables, there we did see that uptick in wind power generation, moving it closer to the same levels as we saw last year, but still lower than one would have expected at the beginning of the year. And then looking at solar power generation, there we see that at the highest levels we've seen, due in large part due to that increase in installed capacities. Looking at fossil fuel power generation, we see particularly coal at the lowest levels we've seen, while fossil gas generation remaining just above last year's lows. Lastly, looking at the guarantees of origin, there we see that continued bearishness across production years and across technology types, with pricing moving down near the lowest levels we've seen over the last 8 months, very much driven by the improved renewable power generation outlook across Europe. That covers this week's market update. Thanks for joining.